All right, welcome back. 100 days into the Trump administration, and the banking industry still waiting for promised deregulation. Between that and the trade war, CEOs having a tough time predicting what the months ahead will look like. Rob Holmes is the chairman, president, and CEO of Texas Capital Bank. He is with us today at Post 9. It's good to see you.
Thank you, Scott.
It's good to get your perspective through all this, through the first 100 days. It hasn't gone as many people expected, you included?
Been quite eventful. We did a business survey. We surveyed 1,000 business leaders and CEOs across the state of Texas. It came out in January. They were very, very optimistic. 50% said the national economy was going to thrive. 80% said the state economy and national economy was going to thrive. About 72% said revenue was going to go up, and over 60% said they were going to hire. You compare and contrast that to the information that came out Monday, the Dallas Fed survey, manufacturing survey, and shipping orders are down, shipping's down, orders are down. What's up is raw material prices and uncertainty.
Have you ever sort of run your business through the level of fog that many CEOs are feeling today? And do you have any indication in your own mind when you might get a little bit more clarity on where things are going? Well,
fog is a good word. The uncertainty index is very, very high. And what we do is we carry an abundant amount of capital. So we have sector-leading CE Tier 1 capital, and our tangible common equity, tangible assets is 10%, which is also very, very high. We run the bank at a very conservative approach. Having said that, it is affecting decision makers. You see people investing less in inventory, except those that are bringing inventory purchases forward. And certainly capital markets, borrowing and investing in CapEx and M&A is on hold.
Loan demand, the real view of the real economy from your perspective in the Dallas area. What can you tell us first about loan demand?
Loan demand, we're by some counts the largest lender to Texas business of any Texas-based bank. So I would say that we like being in Texas, right? There's more jobs created in Texas each of the last 3 years than the other state. We have more people working there than live in 46 states. And the population growth is immense. In the last 2 decades, we've had more population growth than any other state, including last year. And so it's where you do want to be. Our loans grew last year about 4%. Year-over-year first quarter. For the full year last year, they grew 10%. Deposits grew 13%. So we're seeing loan demand, but that was a different world than we're living in going forward, right? And so the vast majority of capital markets transactions and new loan demand last year even was for refinancings, not new capital.
The vast majority of those who are looking for loans from you, I would assume, you correct me if I'm wrong, obviously, small business, medium-sized business, or are you talking like the biggest of the businesses in the area?
Well, we led the largest sole managed debt deal in the country 2 years ago. We did the same last year. We're a top 10 arranger of syndicating bank debt for middle market companies in the country. So our view is pretty broad and wide.
Rates. Obviously, the market was unsettled by the move higher and the quick move higher in rates, the unsettled nature of the bond market. Where are rates going from here? Obviously plays a direct place in the way that you see your business going.
Well, in the interim, there has been some upward pressure, but since called November 5th, the whole curve has come down, and the market is actually doing the job of the Fed for the Fed. So the front end's down more than in the higher end's going up, and so it's steepening, and the front end's down because of tariffs and concerns about a recession, and the back end's going up because of government spending and inflation. So rates, our CIO thinks 2 cuts between now and the end of the year. I've heard anywhere from 2 to 3. I don't think there's going to be cuts. If you listen,
none at all?
I don't think so, but I'm an outlier. So I think if you listen to what the Fed says when they talk, or you read the transcript, they're heavily favoring inflation and the dual-pronged mandate, deflation and jobs. They're heavily favoring inflation, and they're very concerned about the population that inflation has been oppressing all these years.
They've talked, too, though, about the conflict, if you will, of the mandates. And if you start to have a labor market that deteriorates, they could find themselves in a precarious position of trying to make a decision whether they should cut rates at a time where, as you said, inflation is obviously still elevated. How do you view that?
I view that as they're going to need hard data and facts, and it can't be the soft data. So consumer sentiment and that data, I think they're going to have hard facts to rely on. They cannot get this wrong.
You're just not a small bank, a small regional bank. I mean, you're building out a full-service banking business.
Yes, sir.
Investment banking business, you're in the process of still building that out. So when we come into the year thinking, well, animal spirits, deals are going to be everywhere. There's going to be all this capital markets activity that hasn't materialized. What's your view?
So that's why we did what we did. So I think it's going to be very, very hard for a NIM bank, a bank that relies on just net interest margin, to earn its cost of capital through market and rate cycles. I think you have to have other products and services to be valuable to your clients and earn your proper return. So you're right. Capital markets is down. Syndications fees are down. FX is down because the general capital markets investment banking is down. However, our treasury business grew 22% last year. Year over year, first quarter. Cash payments 11%. Wealth fees are up 11%. So between the NIM expansion and the other parts of the business that are doing well, because we have multiple sources of revenue, we've been able to move forward in a right constructive way.
You have more hedges, if you will, within your business.
We have more ways to provide solutions to our clients to make us more valuable to them.
Do you have, last question, an idea of when you think that the deal market is going to pick up?
Well, the debt markets are open. They're about 100 bips higher than April 2nd, it seems. So you're paying a little bit of spread, but they're certainly inside of the highs and spreads. But I think you're going to see the markets open up when we have certainty, and the certainty is going to be 2, 3, 4, 5 of these trade deals announced.